welcome to the Global View with me, Tanvir. This is a special edition where we get a big reaction to Budget 2015, and it doesn't get bigger than market veteran Mohamed El-Erian, Chief Economic Advisor at the Allianz Group, joining us exclusively from London. Mohamed, it's great to have you on the show. Thanks very much for taking out the time to speak with us. Now, my first question to you is, post the budget, the Indian Central Bank has cut rates out of the scheduled policy meets for 2 consecutive times. Do you think this ease in policy will help aid growth for India?
Yes, it will. And it speaks both to domestic conditions and external conditions. I think the second cut that occurred on Wednesday is particularly significant. It shows that the RBI has confidence in the budget that Prime Minister Modi introduced a few days ago. It also speaks to a broader context. We've had over 20 interest rate cuts so far this year by central banks around the world, and India is one of the many countries that feel compelled by external conditions to lower interest rates. So we're having both a domestic and an external signal from this rate cut, and it will be helpful to growth.
Sure, Mohamed, but with the revised growth numbers for the Indian economy, the contrarian view is one doesn't know if the economy really needs an aggressive push via monetary stimulus. The government is expecting 8% plus growth over 12 months and double digit over 24. In that light, with the investment cycle picking up, do you think there is merit in seeing rate cuts fueling the economy into slightly overheated territory? Nobody's talking about it right now, but do you think that could be a risk?
So I don't believe rate cuts by themselves will fuel the economy. I think they help at the margin. What will fuel the economy is the infrastructure spending, is the greater confidence that domestic investors and external investors have in India. That is going to be the key issue rather than rate cuts fueling the economy on their own.
Sure, but if not, then how much more ease in policy do you think will help push growth?
So I think you could see rates come down to 6.5% as long as the budget is delivered, which means that the deficit numbers are met, not exceeded, and as long as you get an inflow of capital from the rest of the world. That will allow the RBI to cautiously reduce interest rates and maintain financial stability.
Sure, that brings me to my next question. Do you worry, Mohamed, of the rate differential trade that could lead to outflows from India and other emerging markets if rates go much lower in India versus the US, where broadly the expectation is that, we're going to be looking at rate hikes a few months down the line? Or would this just be seen as a correction in the policy cycle, as globally interest rates in India are among the highest?
I think it's the latter. I think the real risk that India runs right now is not capital outflows, but excessive capital inflows. You do not want to be the country today with very high interest rates. Because if you are managing your economy cautiously, which is what India is doing, you will attract a tremendous amount of foreign capital. And it will be the short-term nature of the foreign capital that creates the headaches down the road. So I think the capital outflow story is much less of a concern. And I think that the RBI and others are right in worrying about excessive capital inflows that can distort domestic conditions.
Sure. Last time we spoke, Mohamed, you stated that sub 5% growth in India is like recession elsewhere. India's Central Statistical Organization, the data organization essentially, has revised growth numbers for FY15. For India, it's now pegging the number at 7.5%. Well, for FY16, the growth is expected to be 8.5%. How do you see the growth trend for India in a world where growth is a struggle? Can India be an exception?
So as you know, when we spoke last time, I've always felt that India wasn't exploiting its considerable economic potential. And I think growth rates that are in the 7.5% to 8% speak to this concern being addressed. And it's very important for India not just to grow at 7.5% to 8%, but also to make sure it's an inclusive growth rate. And I think that on both counts, one can be optimistic.
Right, then what would be the repercussion of a possible China slowdown on the region? Do you think the worry is still real, or do you think that China has also found its floor as it goes through this transition process in its economic model? They found their floor on growth at about 7%, and they're going to defend it no matter what.
There is, but I'm not a big buyer that China will hard land. I believe that China is among the countries that have soft landed to a lower growth rates, but a sustainable growth rate. In the case of China, we're talking about 6.5% to 7%. To the extent that one should worry about the external environment, and I certainly do, it has less to do with China and more to do with the divergence of economic performance and monetary policy in the advanced world. I think that one has to worry about Europe and Japan facing sluggish growth and downside risks. And one has to take note as to the tensions that the divergence between the US on the one hand, that is improving, and Japan and Europe on the other hand. One has to know the divergence and what that implies in terms of foreign exchange volatility. So when I look at the external environment for India, I worry a lot less about China, and I worry a lot more about the advanced economies.
Right, Mohamed, India growth, of course, will mostly be led by investments in infra, opening up of the debt markets, plus pushing domestic consumption, which is mainstay, has been for a while. Does it disappoint you then that this pickup in growth comes at a slightly eased fiscal deficit number of 3.9% versus 3.6% stated earlier? How should India be cruising on its fiscal consolidation path? Has it been prudent so far?
So I think it's right to think of this budget as a stepping stone towards higher, more inclusive growth, thus the emphasis on infrastructure and also on protecting the most vulnerable segment of the population. And also it's a stepping stone towards well-anchored financial stability. It is not the end of the journey. This is a step in the journey. The next steps will have to continue to involve a reallocation of expenditure towards growth areas, pro-growth, further targeting of subsidies to make sure that they truly help those who need it, and a reduction in the deficit as we go along. So I think this is attainable. Implementation will be key. And I would view the budget and I would view what the RBI did on Wednesday as a stepping stone. It's not the end of the destination, but it's an important step in the journey.
Okay, fair enough, Mohamed. A macro view then, you've been talking about an accidental currency war. Except for the US, a lot of countries are keeping off in appreciation in their currencies. How much can central banks support a low growth environment? And do currencies world over run the risk of significant fall from these levels?
So if you put aside the crisis countries where the currencies are imploding, and I'm talking about Ukraine here, Russia, if you put them aside and you look at countries that are in a more normal environment, it's fascinating. There really is only one significant economy willing to appreciate its currency, and that is the United States. Everybody else is looking to depreciate their currency. Why? Because they're looking for growth. And if you cannot create growth, the temptation is to steal it from somebody else. So what we're seeing is a generalized move towards weaker currencies against the United States. Now that is okay as long as first the currency moves don't cause a market accident, and history is not very reassuring on that, so we have to keep an eye on that. And second, as long as the US is willing to tolerate a much stronger dollar. So far, it's been willing to do so, and it's going to be absolutely critical. But I think that you're going to see the US dollar getting even stronger from here, and it will do so against a very large set of currencies.
Fair enough. With the dollar index at the heels of 100, the Indian currency, the rupee, has fared better than most. Forex reserves in India are at record highs as well. In terms of global shocks, do you think India has de-risked itself in a better manner compared to other emerging markets?
It's certainly less exposed to some of the sources of shocks, particularly the financial shocks and the geopolitical shocks. So it is less exposed, but that does not mean it is not exposed. If Europe were to go into recession, then the whole world will be impacted. So there is no way in our modern globalized economy where interconnections are quite deep, there is no way to totally insulate yourself. So what India has done is it has reduced its sensitivity, but it's not an island in the global economy. It's still impacted by economic trends elsewhere.
Another big trade, Mohamed, has been with emerging market bonds. They continue to draw inflows. The yield for the Indian benchmark is at record lows. Is it still a compelling buy with rates expected to fall perhaps another 100 basis points or so?
So what's interesting is that India is attracting two types of foreign financial investment. One that should be encouraged, the other that India should be very cautious about. The first is what I call dedicated flows. These are investors that understand India, that have done a lot of work, that realize that it's not going to be a linear path, and they will not run to the door the minute there's some volatility, as there will be. The second type of investor is a crossover investor. That investor is not being pulled into India by the Indian circumstances. That investor is being pushed into India by low yields elsewhere, and in particular by negative nominal yields in Europe. That investor is much more short-term, much more unstable, and much larger. So the key issue that India has to manage is to attract the dedicated investor and minimize its vulnerability to the crossover tourist investors, what I call tourist dollars, because they come in all excited and then they run to the airport the minute something goes wrong. And they're not as well informed as a dedicated investor. That is a very tricky equation. And that's why when push comes to shove, India is absolutely right in focusing on foreign direct investment, money that goes into building plant, equipment, hiring, infrastructure, and much less on financial investment, which by its nature is much more volatile. Central banks have been, to use the phrase of Governor Noyer of the French Central Bank, they have been the only game in town. And they have done a solid job with a limited set of tools. There is a limit to how much the central banks can do. And we are getting closer to that limit. But that does not mean, I want to stress, that does not mean that we will necessarily tip into a very ugly paradigm of negative growth, financial instability. We could, but we could also tip in a much better equilibrium if the politicians in the advanced world were to step up to their economic governance. I call it the T-junction. We are along a path that will end at some point because we can no longer rely just on central banks. And there are two clear roads out of that T-junction. And right now, the probability of the two outcomes, relatively similar. So it makes it a really interesting question in terms of how do you navigate this T-junction and how do you position. And of course, it comes down to having resilience and agility. Those are the two key characteristics for dealing with this T-junction.
Ratings agencies, they've been the key talking point. They've improved their outlook call on India, but are shying away to upgrade the investment level to BBB, which is more stable. How much does their perception matter for an emerging market like India in terms of inflows? How much influence rests with them? Because it just seems like, they could open the floodgates when it comes to investment via the debt route into the country.
They have some influence, but I wouldn't stress it too much. They have some influence because investors still take into account ratings, and in some cases they are hardwired in investment guidelines. So they are important. But most of the dedicated investors that India should care about, and most of the foreign direct investment that India should care about, does its own risk analysis. So it's not dominated by what the rating agencies do. They do their own internal rating, if you like, and then they look at what others are saying. So it matters, but I wouldn't overemphasize it.
Sure, fair point. Mohamed, you also stated recently, you'd warned that cheap oil would tip some countries over, countries like Russia, Nigeria, etc. What explains the Russian market's bounce back then, despite a fractured economic model? And also, I wanted a quick view on oil because, the range there seems to be extreme. So it's either, oil is going to hit $100 or oil is going to go down to $10. Where would oil prices find balance over the medium term, according to you?
So I think oil is finding its balance. Let's remember how we've gotten here. We had lower demand, particularly out of China. We had higher supply, particularly from shale and other innovations. And on top of that, we had a significant change in the supply paradigm. The fact that OPEC in general, and Saudi Arabia in particular, is no longer willing to play the role of swing producer, which means it's no longer willing to cut productions as prices come down, that was a shock to the paradigm that was in the heads of oil traders. So when that occurs, suddenly there's no bottom to the oil market. The oil prices will overshoot on the way down, and we did. We've now found a bit of a base, a volatile base, but I think it's a meaningful base at where we are. From here on, I don't buy the collapse to 10 or the rise back to 100. I think we're going to see a gradual path up. It will not be linear, but it will be a gradual path up because there's a tremendous amount of supply destruction going on, and there's some demand creation going on. Now, in that process, there are certain countries that find it very hard to cope with lower oil prices. You mentioned Russia, Nigeria, I would add Venezuela. And it's really important to keep an eye on them because they can be tipped into a rather bad equilibrium because they don't have the resilience that other countries like the United Arab Emirates or Saudi Arabia have.
Also, getting a broader view from you, with factors such as high debt levels, lack of investment, slow growth, falling inflation, are some countries like Greece running the risk of a default? I mean, the market keeps getting nervous about that aspect time and again. Where do you see a potential systemic risk brewing that the market is perhaps not talking about just yet? Or is there none because we are entering into a zone where the market has pretty much adjusted itself to a low growth, low inflation environment?
Oh, there are. I think the first one is what I call the illusion of liquidity. That if you look at how crowded various trades are, there's a belief out there that if the paradigm changes, investors can reposition themselves quickly. Well, the history of the last few years suggests that that's not the case, and there's a good reason for that. And the reason is that the broker-dealer community has been shrunk by regulation and market pressure. As a result, when the bigger end users change their mind and they all go to the intermediary, the broker-dealers, they find that there's a lot less counter-cyclical liquidity than they assume. So my top risk these days is the illusion of liquidity. The second risk is Russia, and in particular the tensions with the West over Ukraine. If we do not see a continued de-escalation of these tensions, if the Minsk II agreement does not hold, then there is a higher potential for Western sanctions on Russia that then increase the probability of counter-sanctions from Russia on the West, and in particular on the supply of energy. So I would put as my second risk the geopolitics. So the first one is a market accident due to the illusion of liquidity. The second is rather delicate geopolitical conditions that can impact Europe's economic growth. And then finally, the possibility of a policy mistake, in particular among divergent central banks. We have one central bank, the Federal Reserve, that's easing its foot off the stimulus pedal. We have two other major systemically important central banks, the ECB and Japan, that have pedaled to the metal in terms of their monetary policy. That divergence imposes a lot of a big burden on the foreign exchange market. And the hope is that other policy instruments in the advanced economies, fiscal policy, structural reforms, will help carry some of that burden, but I'm not so confident that that's the case.
Coming back to India, and you're taking a cue from your view on oil prices, India has been a key beneficiary of lower oil prices. It has led to lower inflation, giving room to the RBI to cut rates. But do you worry that now, after almost 7 years since the crisis, central banks world over are running out of ammunition to push growth, create demand, and avert a strong deflationary trend? What will give way to that downward spiral if we see one? And when will that risk become more apparent, time-wise?
So you are right in saying that central banks are becoming less effective. I don't think any central bank imagined that it would carry so much of the burden for so many years. And like you say, since the global financial crisis, central banks have been, to use the phrase of Governor Noyer of the French Central Bank, they have been the only game in town. And they have done a solid job with a limited set of tools. There is a limit to how much the central banks can do. And we are getting closer to that limit. But that does not mean, I want to stress, that does not mean that we will necessarily tip into a very ugly paradigm of negative growth, financial stability. We could, but we could also tip in a much better equilibrium if the politicians in the advanced world were to step up to their economic governance. I call it the T-junction. We are along a path that will end at some point because we can no longer rely just on central banks. And there are two clear roads out of that T-junction. And right now, the probability of the two outcomes relatively similar. So it makes it a really interesting question in terms of how do you navigate this T-junction and how do you position. And of course, it comes down to having resilience and agility. Those are the two key characteristics for dealing with this T-junction.
Fair enough, Mohamed. Last question then, and this one has had the markets guessing for a while. Do you expect a Fed rate hike by this summer? Have the recent comments from the Fed, all the trends that you've picked up on growth and inflation, and a contrarian view that rates will only go up in 2016 made you rethink your own stance on whether the Fed will actually blink on rates. Do you think they could surprise the markets by doing it earlier than expected? Something that the markets have been nervous about over the last couple of weeks?
So I still think that we are going to get a rate hike from the Fed this summer, which means either at or by the September policy meeting. So by the end of September, I believe that we will have a 25 basis points rate hike. Why? First, I think that the economy and the labor market will continue to heal, and that strong job creation will be accompanied by a pickup in wages. Second, I think the external influence, while negative, is not strong enough to hold the Fed back. And third, as Vice Governor Fisher warned in December, and as others have stated, they are nervous about the fact that markets now assume that a zero rate is normal. They are nervous because that encourages excessive risk-taking, that encourage resource misallocations. Because of these three reasons, I think it's still quite probable that we will have a rate hike by or at the September FOMC meeting.
Oh, absolutely, and everybody will be keeping a close eye on when that event eventually unfolds. But Mohamed, thanks very much for taking out the time and speaking with us today. Really appreciate your views and insights
My great
to
pleasure.
the market.
Thank you.
Well, with that, we come to the end of the special edition of The Global View. From the entire team that put the show together, thanks very much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.